top 5 today. We're going to focus on accounting, so you get props because it's sunny outside and you still showed up today. So thanks for being here today. We have Courtney Duran. She's a CPA and partner with TDT CPAs and advisor. She has spoken several times for us and highly sought after for anything that she does for us. She's proactive in helping clients achieve better results, and she's actually been doing this for about 17 years with small businesses. So I'm not going to take up any more time. I'm going to turn it over to Courtney, and away we'll go.
All right. Thank you, Christina. Good afternoon to all of you. Again, thank you for being here, seriously, on a sunshiny day when we've had a lot of rain to talk about financial health and improving the financial health of small business. So, as Christina mentioned, I am a CPA, so I have the numbers mindset, the accounting background, but I'm actually also a small business owner. So our firm is owned by our partner group. So there's 10 of us who own the firm, and we run the firm. So I'm right there with you as small business owners. I get it. I gravitate more towards the numbers and the financial side of things, but the sales, the marketing, the employee retention, how do I find customers, how do I serve them, all of those things that we all deal with as small business owners, I understand firsthand, and we strive to help small business owners with these same types of things, especially with the focus on finance. Not that you need to have a degree in accounting to run a business, but you do need to understand some of the basics, and you do need to understand how important the information is for you to make decisions about your business. That's really the umbrella on which we're going to talk about for these top 5 things today. All right, so are you all small business owners by show of hands? Everyone is a small business owner. Okay, are you living the dream? I see some smiles and some chuckles. So you probably went into your small business really thinking you would have more control over your time. You'd be able to pursue your passion, probably improve your financial situation, right? That's why a lot of people go into business, or you're very much a visionary. You don't want to work for the man. You've got to carve your own path. But we all have this vision when we go out into small business ownership, where we are really trying to live out our dream and live out our passion. How many of you, this is more your reality than the dream, at least on certain days, right? Owning a small business is hard. It's challenging. Failure rates for small businesses are crazy high. It's stressful. We often find ourselves spending more time than we had anticipated having to spend. The resources, the drain on our time, our energy, and our finances can often be challenging, and what leads to people with some really great ideas not being successful. It's not that the ideas are bad, it's all the other stuff that goes along with running a small business. So if you're finding yourself feeling more burnt out than living the dream, I think the 5 actual concrete steps we're going to talk about today will help you to see a path out of that. It doesn't mean that you have to be the one that handles all of those things, but you do have to recognize that they're important, and that you or someone within your team or your connections and service providers is handling these things for you. So if you're feeling like it's time for a change, I'm excited for you to be here today. We're really going to talk about how, as small business owners, we really need to have timely, accurate, and relevant information about the results of what we're doing. Does anybody feel like you're just doing it, and you're not really sure if all the work that you or your team are doing is really making any money? You're not sure if you really are making an impact, if you're really making the right choices. All of that comes from having the right information to be able to see the results of what you're doing, and that comes through accounting and finance. I know a lot of people feel like they're not numbers people, and you don't have to be a numbers person. You just have to understand some very basic things so that you can make good decisions. Kind of see some what-if scenarios. What if I raised my prices? What if I pay this consultant in this way? Will this make a difference? So we're going to talk about those things today, but overall the big picture is, you really need to have this financial information and to support your decision making. And then you need to be able to communicate to your team and your other employees, or even if it's just for yourself, if you're a solopreneur, what are the measures that I need to really know and understand to move my business forward in a profitable and financially secure way? All right, so these are the top 5, and we're going to go into each one in greater detail, but these are the top 5 ways that as a small business owner, you can improve your financial performance. So the first one is to develop financial fluency. The next one is to accurately account for the past. Third, we're going to talk about refining your accounting system. The fourth one is developing key performance indicator, or KPI reporting. And then the fifth one is implementing performance measures. So we're going to go into detail on each of these 5 steps. All right, so the first one, develop financial fluency. How many of you would consider yourselves a numbers person by show of hands? Only 3. Okay, a few of you, numbers people. I'm definitely a numbers person. That's how I'm wired. But not everyone is. Most small business owners are not numbers people. A lot of small business owners are more visionary, big picture people, and the details of numbers is really not within their passion. We don't need, as small business owners, to have a degree in accounting. We don't need to understand all of the generally accepted accounting principles and all the details of it, but we do need to understand, on a big picture place, the language of business. So I'm going to share a personal story about Spanish immersion. So I've got 3 children. My middle child is in a Spanish immersion program. So we're English-speaking people as our native language. His schooling is all in Spanish. So starting in preschool, the teachers spoke to them only in Spanish. The children can speak in English, but the teachers are always Spanish speaking to them. By the time they get to kindergarten, the children can only speak Spanish in the classroom as well, to each other and to the teacher. So children, in first grade are learning to read. So my son brings home these little libritos, which are small books, to read out loud to me. And we have to do this 20 minutes every evening. So he's reading me these books in Spanish, and he'll read a sentence, and I'll stop him and I'll say, "What did that say?" And in the first few pages, he'll tell me, the duck went into the pond. I'm like, okay, go on. And then he'll read the next page and say, "What did it say?" Because I have no idea what it said. And he'll tell me what it said. We get a few pages in, and he says, "Mom, can I just read the book? You don't need to know what it says." Sometimes in finance and accounting, that's how we feel. Someone knows what this means, and they get a little bit angsty or burnout trying to explain it to those of us who don't. And those of us who don't naturally speak that language, we try to understand, and eventually we give up and we say, okay, I'll let Brady read the book and know what it means, and I'll just, go on about my business. Financial fluency is just as important as language fluency. It's just important for us to really know what this information means. So when we talk about financial fluency, we're talking about the basics of financials. So understanding what a balance sheet is, a profit and loss, some of the key ratios that your lenders or investors might be looking at, knowing enough about what these things mean to really make sure that you're positioning your business and your financial reports in a favorable light. They need to be accurate, but having things misclassified or misaccounted for can really put you in a really bad position when you take your financial information to your lender and you're looking to get an operating loan or expand your line of credit, and they say, "How are you doing?" And they look at your statements, and your statements really don't reflect what's actually happening in your business because you're not accounting for things properly. You can really shoot yourself in the foot. So understanding the basics of financial information and then the language that goes along with it. Not just for talking to your accountant, but for talking to your investors, your lenders, your other partners, talking to vendors and customers, really understanding the basics of financial statements. So, on the balance sheet side, this is your position financially. This is where you stand today. That's what your balance sheet will show you. This is what I have. This is what I owe. and the difference is what I have accumulated or lost over the time of my business. Looking at it through that lens, we use lots of words like accruals and prepaids and deferrals, all those things. You don't have to get all caught up in those specific terminology, but you do need to understand that my balance sheet is telling the world, whoever sees it, my lenders, my investors, where I stand today financially. Do I have enough cash or resources that can easily be converted to cash, such as receivables, money that people owe me? Do I have enough of that to fulfill the obligations that I have, to pay for the lease on my building, to pay back this loan that I'm asking for? Have I established enough equity in this business, enough accumulation of resources that I haven't spent to be able to fund this business if something goes wrong and all of a sudden I have less cash than I had predicted to have? So understanding the basics of a balance sheet, and then also the basics of profit and loss. So this is the focus primarily for business owners, is less on the balance sheet and more on the P&L. How much revenue did I bring in, and how many expenses went out, and what is the net difference? But oftentimes that just bottom line profit or loss number doesn't tell you everything that you need to know as a business owner. Does anybody have their lender talk about EBITDA? Earnings before interest, tax, depreciation, and amortization. So that's a measure that lenders and investors will use to try to equalize and try to compare across different businesses. When you lump into the profit and loss, the depreciation you have on your fixed assets, the interest that you pay on your debts, and your income taxes, all of a sudden the choices that you make about how you capitalize your business and how you depreciate your fixed assets start impacting your profit. So the reason that people use EBITDA, which takes those pieces out of the equation, is to really see, before we factor in what you have to use for capitalizing assets and financing your purchases, just operationally, outside of all of those factors, how are we doing? It's a normalized operating measure. That way I can say, okay, if these two businesses have financed things differently, but I'm really looking at how are they operating, is what they're doing making any money? I would look at EBITDA. So that's something that if you're not looking at already, you might want to consider factoring that into the way that you're looking at your internal statements. What is my overall operating measure? From my operations, before I pay interest, before I account for depreciation and taxes, what am I making from my operations? It needs to be enough to cover your taxes and your interest and to fund the fixed assets that you purchased. But that will give you your true operating measure and allow you to really compare over time whether you're making a profit. We're going to talk about on step 2 how you can even expand that to make sure that you're getting even more relevant information. But just in the basics, understanding, how could I have all this cash but have a loss? Or how could I show a profit but not have any money? I mean, is that possible? Is it possible to have a bunch of cash but not have a profit? Yeah, it is. And it's totally possible to have no cash and have a profit. It depends on the flow of your cash. And so a lot of times we'll have small business owners come in and say, I don't understand what's happening. These numbers can't be right because I feel like I'm making money, but I don't have any cash. Well, did you spend all of your cash on property and equipment and machines or inventory that you haven't sold yet? Are you extending credit to customers and they haven't paid you back yet? Are you paying for things in advance? Really understanding how all of these pieces work together, not just the profit and loss, but how the balance sheet, what you have and what you owe and what you've accumulated, can really impact your overall financial results. Because when you want someone to invest in you or you want a lender to provide credit to you, those are the things that they're looking for. How are you doing financially, and what is the capability that you have to pay this back or to provide me a return as an investor? So having that financial fluency, understanding those things, is really one of the ways that you can move towards financial health. The next one, account for the past. So all of accounting is about reporting what has happened in the past from a financial perspective. Accurate accounting is absolutely foundational towards financial health. If you have financial information that you can't rely on, you have no idea what's going on. And so a lot of times small business owners step away from the accounting side of things because it's not their passion. It's not something that they desire to do, or they don't have time to do it, even if they do have some competency for it. And so they will outsource it to somebody else, somebody within their business or somebody, of another firm, and they kind of go hands off on it. And then they get their financial reports and they say, well, this can't be right. How's this possible? So you don't have to do it all yourself, but you do have to make sure that it is being accounted for accurately, because you need that information so you can make decisions. So if I don't have enough information to know whether I'm making money by selling this product or employing this person or selling this inventory, if I don't have that information, I don't really know what to do to improve my bottom line or to expand my business or to grow and to develop into something else. So you have to accurately account for the past. And so there's some generally accepted accounting principles that are used across all financial reporting. And again, you don't have to have an accounting degree, but you do need to understand, when is it that my business recognizes revenue? Is it when I collect the cash? Or is it when I actually provide the service? When is that? That's how you can get into these questions of, how do I have all of this cash, but I don't have any profit? It's because you've collected money in advance. So let's say that you provide training to your customers, and you collect an amount up front. You collect $1,000, and you're going to provide them with 6 months of training. So right now I have $1,000 in my bank account, but I haven't done anything yet to perform that service. So I don't have revenue from that service yet. I have a deferred revenue. Sits on my balance sheet as a liability because I still am obligated to provide them with training. And when I provide them with training, there's going to be costs involved. There's going to be costs of the space that we use, costs of the speakers that we provide, and I need to be able to match up those expenses, those costs, with that revenue and actually show that for the $1,000 of course revenue I received, it cost me, let's say, $500, so I had a profit of $500. How you recognize revenue is dictated by accounting standards. We don't get to just choose how we recognize revenue. You can choose your basis of accounting, whether you're cash or accrual, but there are generally accepted methods for accounting. So if you are in a construction business, you might have to track your percentage of completion on the work that you do, or any kind of contract work. It wouldn't have to be construction. If you're contracted to do something, you'll have to recognize revenue over the course of the contract, not necessarily in accordance with the timing of the cash that you receive. All of accounting is about trying to match up the revenue that I earned with the expenses that I incurred and put them in the same period so that I can actually see what was my profit or loss from this activity. So having that generally accepted accounting methods for revenue recognition, cost recognition, making sure you know if something is prepaid, that that's actually an asset to you. It sits on your balance sheet, something that you have. It doesn't hit your profit and loss until you've actually incurred the expense. So those basics of accurate accounting are really important so that you've got information to use to really see the results of what you've done. One of the other basics of accounting is making sure you have proper controls in place. So, a lot of times we hear on the news about small businesses or school districts, different governments who have incurred some kind of loss from fraud. And we think, how could this happen, right? Well, small businesses are really susceptible to these kinds of losses because often we don't have enough people to handle all of the duties to properly segregate and really eliminate the opportunity for something to go wrong. So incorporating the proper controls and oversight into your business is also a crucial part of accounting. It doesn't mean that you have to hire 3 more people and have perfect segregation of duties, but it does mean that if you don't have enough people to segregate your duties, you have to have significant oversight. You really have to be looking at what went through my business. So how many of you use QuickBooks? Yeah, yep, QuickBooks is a great tool for accounting for transactions. It's really user-friendly, it's easy to use. It's also really easy to change and manipulate. So a lot of small business owners will have a practice of reviewing the financial reports right out of QuickBooks. They'll say, well, this is what my bookkeeper gave me. Everything that went through here looks totally legitimate, and I feel like, boy, we're losing money, but all of these are legitimate expenses. I know we have to pay those people for those things, and if that's what it costs, I guess that's just what it is. But what can happen is that QuickBooks can be changed. So someone might print a check, mail a check out to themselves or to pay their own cable bill or their own credit card bill, and then go back into QuickBooks and change who the vendor was. And if you get the QuickBooks report, it looks to you like they paid a legitimate vendor. And if you don't actually look at the bank statement and see that that canceled check was to Capital One, which is the credit card company of my bookkeeper, you would have no idea what's going on. So accurate accounting and proper oversight or control is really crucial to making sure that you are protecting your business and all the hard work that you've done from being misaccounted for, which could, really impact your ability to get funding from investors or lenders, or could actually result in a theft if you end up with someone who is really just a bad apple, or even someone who otherwise would have never done this, but they had some kind of rationalization for it, maybe some kind of desperate situation, and they think they're going to pay it back, and you gave them the opportunity because they had full access to be able to do that. So really thinking about that when it relates to accounting for the past, both controls as well as proper accounting. The third one, refine your accounting system. So how many of you have a chart of accounts, like when you print out your profit and loss, or somebody prints out your profit and loss for you, and it has lots and lots of detail? Does anybody have lots of detail? Okay. Oftentimes we find that people have way more detail than they need, and they have too little detail in the areas that would be most relevant to them. So I might have 50 different expense accounts, but between these 25 of those 50, I really couldn't care less if it was advertising for the radio or advertising through the newspaper or online or Facebook. I really could just lump all that together and say, that's all my marketing and advertising expense. So really looking at your chart of accounts and refining it to say, these things are the most crucial to my business, and lumping them into those buckets so that when you look at your profit and loss, things stand out. You don't have to weed through way more detail than is relevant to you because the things that are big really stand out. Does anybody have multiple locations within your business? Yeah, okay. So oftentimes people will have multiple locations or major divisions or product lines, and rather than having all of this detail about the type of expense, it would be more relevant to know, what is my profit and loss per location? Or what is my profit and loss per division? Or my profit and loss or my margin per product line? Or the type of funding source that I have? If I have different methods of, we were talking over lunch that we have a mental health provider here, and so, who pays for the services? What is the margin on service by who pays for it? That might be more relevant to a business owner than the geographic location. But for others, the cost of having multiple locations could be significant, and so knowing which locations actually provide me with profit and margin. So really not trying to just avoid all detail, but incorporating the appropriate level of detail. So less detail about the nature of the expenses that I have, and more detail about the bigger buckets of product line or geographic location, who's paying me for these services. So when you think about QuickBooks, since most of you are using QuickBooks, instead of having a whole bunch of accounts, you would want to have more classes, what they call classes. So you'd look more columnar across your reporting. So this is my revenue from this location, and this location. These are my expenses for each of these locations. This is my profit per location. Now all of a sudden I have information that's more relevant for me. Because a lot of times these financial reports, even if they're very accurate, we look at them and we don't really know what to do with this information. So first making sure it's accurate, and then this step is refining your accounting system to make sure that it gets you relevant information that you can actually use to make decisions. What if I could keep some of this revenue but didn't have to incur the cost of this geographic location? How many of these customers would just go away? How many of them would maybe move over to this location? And now all of a sudden I lose the cost of my extra facility, but I kept, let's say I think I can keep 50% of those customers. I'm gonna have my direct cost of serving them, but I don't have all of this overhead of this other location. When you start to put information in those ways, you can use it to actually make decisions about how you could improve the profitability of your business. The fourth step is to develop KPI reporting, so key performance indicators. Do any of you have a spreadsheet or some other tool besides QuickBooks or your accounting system that you use that really tells you how you're doing? Does anybody have this? Yes. Okay. Most small business owners do. What we want to try to do is incorporate as much of that information into your regular reporting as possible. There's some of the things that are on that spreadsheet that you probably could go back to step 3 here and incorporate into the way your accounting system is set up so that it pulls right out of your QuickBooks account. You don't have to manipulate a spreadsheet on the side. You can adapt your chart of accounts and the classes and the way that you account for things in QuickBooks to eliminate this redundant maintenance of a spreadsheet. So there's some things like that where you'd want to look at that spreadsheet and say, how could I incorporate some of this into my actual accounting system without having it maintained separately? But the other way you can use that is to really incorporate this other statement within your business. So we've got the balance sheet, the income statement, the cash flow statement. We didn't talk too much about that in the first step, but the cash flow statement is really where did all the cash go? How much of my money came from my operating purposes? How much of it came because I had investment returns, or how much went out for investments? How much came in or went out for my financing activities? So those are the 3 traditional statements. It's important to have a 4th statement that really shows your key performance indicators. Those first 3 statements, they report what happened in the past, which can be a good indicator for what to do about the future. But your KPI report, your 4th statement, your dashboard or scorecard that you want to create, using a lot of elements that you probably already have in your spreadsheet, this is what is going to predict your future results. So the financial statements, the traditional financial statements, are going to report what happened in the past. And you need them to be accurate, and you need them to be relevant, but you also need this other statement that incorporates other measures that will be more indicative of what will happen in the future, not just what has happened in the past. So KPIs, the whole point of key performance indicators, is to think through your specific business. What are the things that happen in this business? What are the activities? What are the things that people do in this business that would tell us how we will do in the future? So if you have a business that is based on providing proposals to customers before you engage them, and you might be tracking leads coming in. How many leads did I get this week? How many of those leads were converted into actual proposals? How many of those proposals were won? So if I look at my financial statements, I will see how much revenue did I earn from prior proposals that I won. But if I'm tracking how many leads came in, how many proposals went out, and how many were accepted, I should be able to predict how much revenue will I have in the future? So if I start to see that the leads I have right now are less than I had last week, or less than I had last quarter, or last month, last year, then I can start to see that I need to do something about it. The key performance indicator value comes from having this kind of forward-looking indicator that you can actually still do something about. Because when you look at financial statements, there's nothing you can do. It only reports what happened in the past. Key performance indicators are things that are happening right now that I could still do something about to influence my future results. So there's hundreds of KPIs that you could use. It's important to understand what KPIs are most relevant for you and for your business. And so going through a process of really thinking through what matters most in my business, what would be indicators of future results that I could start measuring and responding to. So I gave the example of the number of leads and the number of proposals. It might be the number of customers that you retain. How many repeat customers do I have in my retail store? Do I have the information to track whether this customer has been here before? And what if they come back 3 times? Once they've come back 3 times, can I somehow start to track how many times they come over a lifetime? Or if I am providing services to clients, maybe it's some element of whether they refer us to other customers. There's all kinds of different things that you can measure around all kinds of different things. There's things that you can measure around sales and marketing, around your customers and your operations or your production, your people, your workforce, your retention. So really, when you look at those elements of your business, they don't all need to be financially related. It doesn't have to be how many days in accounts receivable, how many days sales do I have in AR. That might be one that's important to you if cash flow is a really big impactor on your business, but it might not be what's key for your business. So looking at those 4 areas, so financial indicators, your customers or your sales process, your operations or your production, and then your people or your workforce. Looking at those 4 areas and saying, for my business, what makes the most sense to be measuring and monitoring and then responding to, creating a system for actually capturing that information, looking at it along with your financials and responding to it. Because once you have those indicators and you're measuring them, you can actually start doing something that will change your future results. So in the example I gave about the leads, if I all of a sudden see that my leads are going down, I know that I need to spend more time generating leads. So what is it that I can do or my team can do to generate leads? We've got to focus on generating leads. Maybe we've got plenty of leads and we're not converting enough of them to proposals. What are we doing wrong? What are we missing here? We need to focus on lead conversion to proposals. Something's not right there. Versus always looking in the past and saying, well, my second quarter sales were down. We sold less product. We delivered less service. What else can you say, right? You just don't know what happened. So by looking at the past, but also incorporating these future-looking indicators, you can start to impact your future results. It's important that they're things that are specific to your business, not just any generic indicator. And there's probably several of them already on those spreadsheets that you're talking about that you use to really know what's going on in your business. So just making that more systematic and intentional that you're monitoring that. All right, so I have this slide. I'm not sure how well you can see it here in the room, but I'll go through it. So those 3 financial statements that I talked about compared to this 4th statement, your scorecard or your dashboard, I just want to go through these differences just before we move on to the 5th item to make sure everybody understands, because I think this, for those of you who already have accurate accounting and relevant financial information, this part right here, if you don't already have KPIs, might be for you the biggest difference. If you don't have accurate information and it's not relevant, this is a few steps down the road. These 5 steps are really sequential based on the foundation and moving forward. But for those of you who already have accurate, relevant information, this might be the step that really makes the biggest difference for you. So the financial statements are outcome focused. Your KPIs are activity focused. So the financial statements measure, where do I stand financially? How much revenue did I produce? What were my expenses? Your KPIs are really activity focused. What's happening in the business? What are my people doing? What processes do we have in place? You're looking more at people and process and business activities, less on actual financial outcomes. The financial statements are historic reporting. The KPIs are real time, looking at really how are we doing right now, what's going on in the business. The financials are lagging indicators. The KPIs are leading. This is more, I can impact the future. I can see what's going to happen. The financial statements capture transactions. So what did I pay out in cash? What did I receive in? More cash and in and out transactions. The fourth statement measures the activities that drive transactions. So it's forward thinking. The financial statements are a financial view. The fourth statement, your KPI report, is going to include financial and non-financial. So of those 4 areas, financial is one of the components, but your operations, your production, your people, your activities, that's really what goes into your fourth statement along with the finance side. And then on the financial statements, it's all about the dollars. And on KPI reporting, it's all about the numbers. It's not so much about the dollars involved, though you might be tracking average sale per person or increase in sales from repeat customers. There might be some dollars involved, but it's less about the dollars and more about the volume of activities or what's happening within the business. And then the fifth thing that you can do to improve your financial performance is to implement a full performance measurement system. So there's really 4 steps here. And this involves, when you've got other people working with you, how you can engage them to help you improve the financial performance of your business along with you. So the first step is to really explain the rules of play. You've got to develop your own KPIs, and then you've got to tell your people what they are and help them understand how do they impact the results of the business. So in the example that I gave about the leads, so if I have a salesperson who is just responsible for responding to leads, and they don't know how many leads we should have, how many leads we had last month, how many leads we converted, they have no idea. They're just doing it. Once I tell them, we need to convert, 50 leads per month, they all of a sudden say, oh, 50 leads per month, okay, I didn't realize that. So they start to have some ownership in converting 50 leads. And if they're at 30, they have this sense of, I'm not going to reach my goal. So really explaining the rules of the play, educating your team about what are the measures that are most important to the business, and then posting the score, giving them feedback so that they know how we're doing. The third one is recognizing effort. Not everything's going to just change on a dime, and we don't want people to be discouraged if we aren't meeting all of those measures. So recognizing that we're trending in the right direction, or we're doing well, or we need to get better and we really appreciate all that you're doing, really recognizing that effort. Because it takes time before all those changes appear on the bottom line. And then the fourth one, rewarding improvement. So a lot of small businesses, when it comes time to reward their employees with raises or bonuses, it can feel challenging and kind of arbitrary. And how much of my profit should I share with my people? How do I really recognize what someone is doing? When you have a full performance measurement system, you have these key performance indicators and you tie people's results to them, all of a sudden you have a basis for rewarding them. You can tie their compensation adjustments and their bonuses to their number. If you say, for you to impact this business and for us to be profitable, I need you to convert 50 leads a month, and they consistently convert 50 leads a month, all of a sudden you can say, okay, they had a huge impact on the profitability of this business this year. I now have some way to tie that back to how I reward them for that. What gets measured gets done, and what gets rewarded gets done again. So measuring is the first step, and then rewarding is a way to make sure that people continue to engage with that activity. So if you feel like you're ready to get back to your passion of why you started this business, you're really ready to be more profitable and to feel like you have more control over your time, I genuinely believe that these 5 steps that relate to the financial side of business are crucial to helping you to get there. You have to have good information to be able to make decisions about your business and to know, what if I do this? How could that impact me? If I need to go and request investor funds or loan funds, what do I need to understand about what my financial health looks like? How likely is it that I will get the money? Or what do I need to improve before I go and make that ask? What do I need to prepare for to really show that my great ideas will work and be profitable? That really requires some basic financial knowledge and understanding of accounting. Again, you don't have to have an accounting degree, but you do have to understand some of these basics. And if this is something that's really not your passion, there are other people in your business or in your community that are passionate about these things. And so you can't just ignore them because it's not your thing. You have to find someone who really is passionate about this and can help provide you with the information that you need to make decisions about your business and to really measure your performance and start not just accounting for the past, but really having a plan and a strategy to improve your financial results into the future. So I hope this has been helpful to you. I would love to hear some of the thoughts or questions from those in the room. I don't know if we take questions from online. Christina will know that,
But we do have time for questions. I'm going to have you ask in the mic. Otherwise, our viewers cannot hear you. So if you have a question, just let me know.
always hard to be the first one. Is anybody doing any kind of KPI reporting right now?
That they can share, because that's a really good...
Yeah. Yeah, we've got a couple in the back that are willing. And one in the
Christina.
front.
And I would like to expand it a little bit more. We do look at proposals converted into sales and what our percentages are.
Okay.
And we have found that personal referrals are our most successful conversions from proposals to sales.
Okay.
Rather than getting random leads or social media leads.
Sure. So rather than focusing on all kinds of social media, then you have to focus on, how do I build referrals? Are those referrals coming from your existing or prior customers or from other third parties? Your customers. So for you, you might be measuring not just the, where did my work come from? Maybe I know that now, but how satisfied are our customers? Because if most of my work comes from existing customers, I need to create raving fans. And so how happy are my existing customers? So some element of measuring the satisfaction of the customers, and maybe you even put effort around, what are the things that make a difference to them? What are they so happy about that leads them to refer someone else? Or how easy is it for them to refer someone else? Are we asking them to refer other people? Maybe there's some element of saying, telling your team, or maybe it's just you and you're just telling yourself in the mirror that my business comes from people referring me. Do I give off the notion that I'm already busy enough? Or do I give off the notion that I would love for you to tell your friends that I could help them in the same way? Or I love helping you. If you have other, friends or associates that are in a similar situation as you, I'd love for you to tell them about that and start measuring some of those things. That's awesome. I think we had somebody else back there.
Hi. A couple of other KPIs that we track are just related to hours. We work in commercial real estate, and so a lot of what we do is like architecture, interior design, owner's rep, project management work. So a lot of it's hours driven. Billable hours as well as and like utilization for how much
Okay.
employees are working and spending on overhead items, as well as client surveys to get that satisfaction rating and feedback from clients. We track that as a KPI, and our win-loss rates for proposals, and a lot of that information is shared with the whole team. So have a look at how they can impact the financial results.
Great, that's awesome. Those are similar to our business. So if you're in professional services and you're not quite sure what kinds of measures would we have, utilization of people is, a huge indicator, because if I'm going to pay these people and the only way we earn any revenue is if they do billable work, I better have a pretty good understanding of how much billable work do I need them to do to cover their salary and be profitable. And if I have more work than I can handle, at what point does it make sense for me to add another person? Or is there some work that we do that is really not that profitable, and I would be better suited to discontinue this kind of low margin work rather than add another person and try to fill them up? Because oftentimes in small business, well, I'm sure it happens in large business too, but oftentimes we are doing so much and we don't realize that some of what we're doing is breaking even or losing us money or making us just a little bit of money. And once we start having this information to really see that, then we can say, boy, it feels uncomfortable to get rid of X number of dollars of revenue. But when I realize that I am paying them, to do this, I'm losing money on this, and here I am all stressed out, and I've got all these people I have to manage, and it really doesn't even make me any money, or doesn't make me enough money to be worth the effort. Those types of measures, especially in professional services, are wonderful examples. Do we have time for a couple more?
Just to kind of piggyback on that, we call it efficiency. So I've got a young crew, and so we track, what their efficiency is on a sometimes a little bit harder on a weekly basis, but for us, for sure, on a monthly basis. And then we've set up a bonus program that bonuses them, profits based on what their efficiency is and goals and things like that.
Okay, great. Do you have much lead time on knowing what work is going to come in for them to do? Like, do you have a
It
schedule?
depends on the season. I'm in collision repair, so the winter time it may be I'm scheduling a month out, but the summertime it may be I'm bringing in cars, every day that I don't know that's coming that I wasn't expecting. So
okay.
yeah.
Yep, that creates another element. How many deer have been out in the highways? Yeah, for collision repair. Yeah, those are great. Really looking at efficiency, productivity, utilization of resources. If I've got these resources to deploy, how can I make sure that I'm actually deploying them? And in a business where you have some backlog or you have some ability to schedule, for some people it's even backing up further and saying, okay, this is the bucket of hours that I've got here, and this is all the work that I've got. Do I have enough? Do I need more people? Do I need more work? Because some people just don't even take the time to step back and think about that, and they're just in this constant state of craziness. And in some businesses, you don't have the luxury of repeat business. I'm sure you have repeat business, but it's not like an accountant would have. Everyone's always going to have this accounting work done, but hopefully not everyone hits a deer every September or whatever. But yeah, just looking at what are the resources that we have, what is the availability, and starting to measure those things to be more predictive and less reactive. Because oftentimes it takes too much time and effort to go back and figure out what happened, and there's nothing we can do about it because it's already done. So spending the time thinking about what are the activities that drive, it's looking at the number of people I have, what do they get it? For those of us that have employees, I think we as business owners sometimes, forget that they don't necessarily understand what drives the business like we do. And it's because maybe they're young and inexperienced, or they've worked in a whole different type of business or industry. helping that fifth step, that performance manager step, engaging the team, telling them their numbers. So for you, maybe you're telling your people, like, if you're going to be here 8 hours a day, I don't know, 7 of those hours you should be logging work on a project. Because if you're not, we're not going to have enough money to pay raises. But some people just kind of come in and do their thing, and they don't even realize how they impact the profitability of the business. And until we take the time to determine those numbers and then share them, we might perpetuate that. So that's great.
Other questions? One of the questions I get asked a lot is how often should they be reviewing reports? And I know you covered a lot of reports today, but not everybody uses the same system. But what reports should they be looking at? How often should they be looking at them?
Sure. Yeah, great question. So when it comes to KPIs, when you develop your KPIs, when you determine what are these indicators for my business, you want to think about how frequently should I look at this? Because some KPIs you want to look at every day, some of them are every week, some of them are every month, some of them are only every quarter. So when it comes to KPIs, that's just part of the process of developing your KPIs, is to say, how frequently should I look at this? And that just depends on your business. But just to know that some KPIs you want to have your finger on every day. So if you're a restaurant, you might want to know every night how many people are standing in the lobby of my restaurant at 6 o'clock. Because if I know that, I have a pretty good idea of how much revenue I'll have for the evening. So maybe that's something that you have your manager capture every evening and report to you. But there's other things that it just wouldn't be meaningful to know every day or every week. So when it comes to KPIs, it really depends on what the activity is. For financial information, you have to look at it every month. So there should be a process of reconciling your bank account every month. That I'm not saying you have to do it, but someone needs to be doing it. Your accountant or your outsourced accountant, someone needs to reconcile the accounts, and then that way you know, okay, everything that went through the bank has been recorded in the book, so I should be able to look at this information and know that it's all here. So after that's been done, you need to be looking at those financial reports. And if you don't have proper controls, if you don't have enough people to properly segregate the duties, meaning someone who does your accounting has access to the actual money and the accounting, then you have to look at the bank statement every month. Or some people look at it online, every week to see what's going through there. You just have to look at what actually went through the bank, not just what's on the QuickBooks reports.
Awesome. Well, I think that we will wrap up. I'll let you hang around for a little bit in case people have more specific questions, but let's give Courtney a round of applause for being here with us today. Things I want to mention briefly. We have surveys on your table. If you can fill those out, and specifically if there's other classes that we can help you host, we go out to RFP in November, and I always include whatever is listed on those as suggested topics. So if you can list any of those that you're looking for. June 7th, we will have our first Fridays here. It's our female entrepreneurship series. We're featuring Ying Sa. She'll talk about her journey to her company. June 26th, we'll be back in here, and we're talking HR. So I know a lot of you raised your hands or talked about employees. We'll be talking about employees and HR mistakes to avoid. And then I did want to mention the Small Business Success Summit, which several of you have attended. The registration is open. It's November 8th this year. We are out for RFP for our breakout sessions. We'll be announcing the 3 keynotes very quickly. It's $79 for the entire day. We do expect that to sell out again. So if you want to get registered early, that is open for you. So thanks so much for coming today, everybody.